So George, what does it mean if the seller or my real estate agent suggests that we have the seller carry back a second mortgage on the house? Is that any kind of a benefit for me, and how is that different from a traditional seller finance transaction? Well, thanks for coming into thecreditjungle.com today. This is George Anderson.
George of the jungle, strong as he can be.
And believe it or not, I've actually had a couple requests about this. So that's where 99% of my videos come from. It's called talking to people every day, figuring out scenarios and what people are doing to try to be able to get financing to get into a home. And so a seller carryback second is different than when we're doing a seller finance transaction like we've talked about previously, where we're doing contract for deed, all-inclusive trust deed. In those transactions, the seller still has an underlying mortgage obligation that is in their name, and you are doing financing on top of that. On a seller finance carry second, what we're doing is we're actually cashing out the seller, transferring title to the buyer's name, and then the seller is actually taking a portion of their equity and putting it in a second mortgage position. Now, there are some companies out there that will offer what is called concurrent subordinate financing. In other words, you can close on a second mortgage at the same time you're closing on the first mortgage. And in the past times we would do this, people would do it to avoid getting jumbo pricing. Right now, jumbo pricing is not that much difference. People would do it sometimes to avoid mortgage insurance. But there's pricing adjustments to be able to do a seller finance carry. We're going to talk a little bit about what those pricing adjustments are and what type of loan programs they're available with. But there are some times when this can be a very good situation depending on somebody's circumstances. And let's just go through the numbers on this. So let's just say that we've got a buyer that they qualify to get a $600,000 purchase price home, and they've got 5% down, or $30,000. Now, in this case, let's just say that maybe the buyer has, the seller is not willing to do traditional seller financing. The seller just says, look, I want all my equity out of it, and in this case, or he just wants to have his mortgage paid off. He doesn't want to have the buyer assuming, moving in, keeping the loan on there. There can be a number of reasons on this, but we can clear out the mortgage on the seller's loan as long as he owes, less than the amount that we're trying to finance on the first mortgage. So in this case, we say, okay, well, Mr. Seller, what I'd like to do is I would like to, rather than getting a $570,000 loan, I'd like to qualify for a loan that is $480,000, okay, which is 80% of the $600,000. The seller only owes, let's just say the seller owes $400,000. This means that at the closing, the seller is going to get, add a zero. The seller is going to get his $80,000, okay, from the sale, because he's got the $400,000 balance on there. But he's going to put another $90,000 right here as a seller finance second mortgage, okay? So the seller has got $90,000 of his equity that he's not going to receive right at the moment. And there can be tax reasons why the seller might want to do this. The buyer might have additional money coming in. Maybe the interest rates are good right now and the buyer wants to get at the rate that he's got right now, and he knows that maybe he's got another property that's being sold. There's just something going on, that this might be a short-term loan, and you can make the terms of that loan. The seller can make the terms of that loan just about whatever they want. They like to see at least a minimum interest-only payment at some kind of a normal interest rate and not a balloon within the first 5 years. You also cannot do this on most traditional just Fannie Freddie programs. You've got to go into some of the Home Ready and Home Possible programs to get this. And when you do have it, there is a pricing adjustment. So I'm not going to get into all of these details, but that pricing adjustment can vary from anywhere from 0.625 to 1.125. And there's just some times where you find weird circumstances and you need to make something work. But this basically gets the amount. You take the loan amount plus what the seller is carrying plus what the buyer has a down payment, and the seller can get his purchase price of $600,000, and the borrower here has a nice 30-year fixed rate mortgage with no mortgage insurance, okay? And sometimes maybe that pricing adjustment is more expensive than it would be to pay mortgage insurance, then this might not be a good idea. But if the pricing adjustment, in other words, the cost, the points or whatever to maybe get a little bit better rate, if that's less expensive than mortgage insurance, then this would be a better route to go. So I don't want to get too lost in the numbers on this, but I've had a couple questions about what is a seller finance second, and that's what it is. And you can do this. So this one, just to get in some of the terminology, this one here would be what we call an 85 and 15. We've got 80% first mortgage, 5% down from the buyer, and a 15% seller carryback. That's the minimum. You have to have a minimum of 5% down. You can do these things as, they can be done as 80, 10, 10. Okay, they can be done as a 75, 10, and 15. You get the idea. As long as these three numbers add up to 100, this middle column is normally going to be the buyer's down payment. This column here is going to be the amount of seller financing that the seller would carry back. So hopefully that helps you out with the explanation of what is a seller carryback, and maybe you find a deal where it can work for you, and I would love to help you with it. So push button, get Mortgage Professional, and hope to talk to you soon. Have a wonderful day.
George of the jungle, strong as he can be.